Hello, Sean Innings here. Welcome to the MicroCap Club Member Spotlight. In these interviews, we showcase many of the talented members of the MicroCap Club. Today, we have Chip Maloney, a private investor. Chip, thanks for joining us today.
You bet. Thanks, Sean. Been looking forward to this.
So, Chip, tell us a little bit about your background, what you're doing today.
In terms of a background, so I had a lot of jobs growing up. Newspaper route at 12 years old. Was a pizza chef. I was pretty lucky to be thrown into a position in this pizza shop at 14 years old, where within a couple months after I stopped burning pizzas every day, cutting into the cost of goods sold, they gave me a responsibility to run it by myself at night. It wasn't a super busy shop, but it was really neat to sort of learn operations of a business and learn a lot of business lessons just in that job. And so had a bunch more jobs, and then I had a construction job after I finished grade 11, just during the summer. And about a week of that job, I ended up having to do insulation work. It was a construction job, like they make these fabricated trailers, like you see on oil and gas sites. And so I worked in every area of that, doing sheeting on the outside, doing framing, doing some finishing carpentry. But this insulation work for about a week, it was just miserable. And I don't know, Sean, if you've ever done any insulation work, but it's not pleasant. So, you're itchy all day, your throat is dry, and you get home at the end of the day and you have to have a cold shower, because if you have a hot shower, it was that pink insulation.
Oh,
so the fibers just kind of get into your pores and make it even more itchy. So if you have a hot shower. And so I kind of realized at that point that I didn't really have a passion for construction. And that at that point, I remember kind of at the end of that week, I decided to follow in my dad's footsteps. He was a chiropractor. And I decided at that point I was going to go on to do my chiropractic training. So, I after high school, I attended University of Alberta here. I live in Western Canada, and in Edmonton here, I did my 2 years of prerequisites in science. That's what I needed to get into chiropractic school. After I finished that up, I took a couple years off just to earn the money for tuition, and I also wanted to just make sure that's what I wanted to do. And so it was kind of a 2-year gap there. At that time, my uncle, he was the superintendent of the oil and gas company. And fortunately, he believes in nepotism. And so he hired me on in this really good paying job for about 1.5 years of that time. And so I was able to save up a lot of money for tuition. At the end of that, I took 6 months off just before I started the 4 years of schooling. And I went to work as a ski instructor, and I was a ski bum for 6 months. And so that was a lot of fun. I skied about 100 days that year, and I think I was working about 15 or 20 hours a week. But working on a ski hill like that, it's like, I do these ski lessons, and they would charge $25 for the lesson for all these ski customers, and I'd take about 8 of them out, and they'd be paying me $6.50 an hour, and they'd be generating about $200 an hour in revenues from this, or maybe they were an hour and a half. And so I realized that I got to do something here to capture a little more of the value. It's kind of a mismatch there. So anyways, I think that was a good business lesson for me. So moving on, I did my chiropractic training in California. I spent 4 years there. It was really interesting. It was kind of the mid-90s and to the late 90s. And I was right in the Bay Area, kind of the heart of Silicon Valley. And so at that time, I wasn't really thinking about investing at all in business at that point. But it was like the Cisco Systems campus was like 2 blocks from my school campus. And I drive past Cisco every single day, and it seemed like every week or two they'd be building another building to kind of expand. And so I had a couple of classmates who they actually took their student loans, and they actually invested in Cisco Systems stock, and they ended up doing so well on that. By the end of it, they paid off all their student loans, and so that was kind of my first sort of real exposure to what stock investing might be able to do for you. So from there, I graduated, spent 4 years in the Bay Area. I took a year to travel and work in Australia. And so what I would do there is when I got there, I just blasted out. I didn't want to spend a lot of money sort of faxing out and paying the telecom fees and the long distance charges for faxing out to every chiropractor in Australia. And so I sort of found this loophole. I went to the library and I realized in there they had this employment section. And so what I did there is it was free. You could use their fax machine. And so I think I racked up probably, I bet you it was $500 in fees for Australia. Faxing to every single chiropractor in Australia. I got this guide with everybody's fax number. And so anyways, I lined up work kind of as I traveled around the country. And so I ended up working about 6 months. First 2 months, I met a friend there. We split this 1978 Ford Falcon. It was a beauty. It was this green station wagon. And so we spent a couple months kind of driving around sort of the East Coast, kind of South Coast, and over to the West Coast, and just kind of surfing along the way. And we slept in the car every night. We had this inflatable bed in the back, and that was just awesome. You wake up every day on the beach, and that was a fun time. So after that, kind of got homesick for family and friends, and so I moved back to Western Canada, and I've been practicing as a chiropractor ever since here.
So at what specific point in that timeline, so you got into investing at one point, but then you must have gotten introduced to microcaps, and can you tell us a little bit about that time?
Yeah, absolutely. So after I started working, you have kind of a frugal lifestyle, and when you start making income, you have disposable income, and so pretty quickly I realized that I should put kind of my disposable income to work. And so real early on, it was sort of early 2000, I did a couple hours of research on mutual funds. I had read The Wealthy Barber. My mom had given that to me early on. And they talked about investing in mutual funds. And so it was kind of right at the peak of the tech bubble. I went to the bank and opened up a kind of dollar cost averaging sort of account into this best performing science and technology fund. Had the best performance over the previous 5 years. And I think within like 4 months, I think I was down like 60 or 70%. And so it was back to the drawing board. And so said, I got to figure this investing thing out here. And so like probably a lot of people listening to this, one of the first books I pulled off the shelf of the library was a book on Warren Buffett. And it was just, it just made sense to me immediately. And so that led to, Benjamin Graham and Phil Fisher, Greenblatt, Klarman, obviously, reading what the greats have done over the years. And then I also was exposed early on, because I'm in Canada, I was exposed to some of the really successful investors in Canada, guys like Tim McIlvaine and Francis Chu, Eric Sprott, Tom Stanley. And all of those investors were investing in small companies. I'd pull their shareholder letters, and they'd have a listing in the stocks in there, and a lot of them would be microcaps. And so, right from the start, I was pretty lucky. I realized that microcaps had much higher returns. I read Jim O'Shaughnessy's book, What Works on Wall Street, fairly early on. Excuse me. And in that book, obviously, he talks about one of the best, investment asset classes is microcaps with the highest returns. And then I also came across something from Warren Buffett. I'm sure you've read it when he talks about, someone asked a question, I think at one of the annual meetings, saying, what would you do if you went back to $1 billion portfolio? He said, yeah, I just, go A to Z through all the stocks, looking for little tiny wrinkles. And so that's sort of early on what I did in Canada here. Instead of Edgar, we have the CEDAR system, which is this is not it's not very good.
Getting worse over time, right?
Yeah, and you know, it actually is a little bit of a barrier to entry. So it kind of keeps people out of Canada, I think, which hopefully it stays that way. And so anyways, I went A to Z. I spent probably, I don't know, 6 months going through every single stock. I built a watch list, and at that time, I think I looked at every publicly traded company in Canada. And so in terms of, you know, MicroCap Club, so I remember, I think it was about 2014, I think, and Paul Andreola had written an article for the MicroCap Club blog, and I noticed that, like, I own probably half the stocks that he was talking about. And so then I went to the MicroCap Club site, and I saw there was like this little tiny box on the side, and it had like the most recent 5 chats, but it like blurred out most of what was being talked about. And so I saw this, and it was just like a teaser. Maybe we should add it back. But it was like, I got to get in on these conversations with these companies that I own here. So anyways, I put in an application for a write-up, and got accepted, and it's been a wonderful experience. So
awesome. And it seems like you have a ton of different experiences, you know, from the ground floor of a business, you know, from insulating to pizza shop and all that kind of stuff, and, you know, traveling through Australia. So with all of that experience, it seems like you've come up with an interesting way of looking at businesses. Can you just talk about that, and if that all those experiences have shaped, you know, who you are and your investing strategy?
Yeah, I think looking back, I mean, connecting the dots now, obviously being exposed to a lot of different businesses like that, you know, I mean, if you think about it as probably a lot of people watching this have had a newspaper route, but it's like at 12 years old, it's like there's so much responsibility given to you for that, and it's like basically like a little small business, right? And so you learn about customer service, accuracy of delivery. It's like, you know, every day you'd have a couple customers out of 100 that would be on holidays, and so, you know, if you delivered a paper mistakenly, you get to the end of the route, you're like 1 paper short, you got to go all the way back through. So you learn about, like, you know, in the middle of winter, you want to be out there as little time as possible. So you learn about like route efficiencies and, you know, just little things like that, you know, customer service, collections. Like a few of my customers, you could tell they were living paycheck to paycheck. So you sort of figure out when to go collect your cash, you know, right after they got paid. And so little things like that, I think were really good business lessons all the way through. And so just being exposed to, like, as a pizza chef, you know, running this business or running the operation by myself for 3 hours a night, just seeing how hard it is when you have an employee like me who's burning pizzas, and it just comes straight out of your profits. And you know, we get maybe 15 or 20 orders a night, and, you know, at $20 per order, it's like you add up the you know, the revenue, and it's like, you know, they're leasing the space, they're paying me, and there's a delivery driver, you know, inventory costs. These are, you know, tough businesses. And so generally I've sort of stayed out of these businesses that I think are pretty tough. You know, I spent the time with the oil and gas company. It's like, you know, I helped the operating crew with maintenance, and, you know, they had these like $2 million turbines, and when they would go down, it's like the whole operation would just stop and be a bottleneck. And spent a lot of my time there, like, painting rusty pipes. And it's like, I don't now seeing that, I don't invest in anything that rusts, right, that has assets that rust, because you see the capital intensity of these businesses and how much maintenance it has to be done. So I've kind of gravitated over time to kind of asset light businesses, and I think that is part of the reason, right? So
and what would you say would be your investing strategy? Is it more value oriented with those asset light businesses? Is it more growth at a reasonable price?
Yeah, so definitely when I started, I really identified with value investing, just studying those sort of value investing grades. Definitely growth is a big component. These days, I just think of myself an investor. I'm just trying to get the highest return on my capital with the lowest amount of risk. And so, but my favorite strategy is kind of like GARP, but I'm pretty cheap in the prices that I like to pay, and so I call it Gulp. And so it's growth at an unreasonably low price. And so, you know, to the growth part, you know, I'm investing in probably similar businesses to all the members. I mean, I'm looking for, you know, companies that might have an emerging moat or some sort of niche, you know, profitable growth, high returns on tangible capital, you know, increasing margins. I've sort of really gravitated towards recurring revenue businesses, and so a lot of these businesses that I'm investing in are more like B2B businesses. And I own a lot of serial acquirers as well, because I find that if a smart management team can do smart acquisitions, that can kind of juice that growth per share. And then the low price part, you know, usually there's got to be some sort of black clouds over the company, and so so generally it's companies with low expectations that I'm investing in. Hopefully they're temporary. I kind of break sort of these black clouds into kind of 4 categories. And I like watching movies, and so I've kind of broken them. It's kind of like mental models, the way I think about these black clouds. And so so the first category is rocky companies, and so, you know, these would be companies like Expel, or companies that get hit in the head with a patent lawsuit or something along those lines, maybe a short report or something. The second category is what I call Beauty and the Beast companies, and so they might have like a division that's not very attractive, but they have another division that at some point, if they announce maybe they're selling the kind of sort of more mediocre business, then that might sort of showcase the attractive business. And the third category I call Benjamin Button stocks, and so it'd be like stocks or companies that might be sort of perceived as buggy whip companies, but they're actually growing, and they're actually much better than sort of what you see on the surface. And then the last category is kind of that I sort of bucket these sort of black cloud companies or situations as Forrest Gump stocks. And so, you know, Forrest Gump obviously had very low expectations for him, but, you know, you look at what he achieved. I know it's fictional, but you see, you know, he became a champion in ping pong, and you know, this college running back, and you know, super successful businessman. So I'm looking for maybe companies that might have a misperception, and they are maybe hidden champions. And so that's sort of how I classify sort of the categories of stocks that I'm really looking for that pattern. So
cool. Chip, also recently on the club, we had some discussion on company culture. Do you have any just kind of overarching thoughts on that you'd like to share with some of the viewers?
Yeah, so I know you've been studying culture for a lot longer than me. So I'm still sort of fleshing my thoughts out on it, but I think culture, from sort of what I've sort of looked at, it can definitely be a competitive advantage for a company, and it can be a very strong competitive advantage. It's very difficult, I think, to research. So I've been doing a lot of reading and watching a lot of videos from people who've done a lot more work than I have. And so right now I'm in the middle of reading a book by Ben Horowitz, and it's called it's not what you say, it's what you do. It's something along those lines. And then another one from Jim Heskett, who he's a professor at Harvard who has done a ton of research and consulting in the industry on corporate culture. That one's called Win from Within, and he's written a bunch of other books. And so I'm just kind of fleshing out my thoughts on this. I think, you know, Ben Horowitz talks about it's not what you say, it's what you do in a business. And so sort of looking at their actions, right? And he uses the example of in the VC industry, you know, for him, it's very important to put the entrepreneurs that they're investing in at very, like, he says you need to respect them, but a lot of VCs, their actions, they don't really show respect, and so they'll show up. The VCs will show up late to meetings. So he's put in place this. It's basically a reward punishment system where if their partners are like 5 minutes late, he says you're paying like $100 for that first $100 a minute or $10 a minute for every minute that you're late. And it's like you put in place these rewards, and I guess it's how you reward and punish behaviors, right? And that's really what leads to the actions that come out. It's like all about incentives, right? It's like incentivizing people. And then another thing that I've been sort of researching, WCM Management is an investment company, and so they've got 2 corporate culture analysts on staff. And so there's a fellow named JB Horner who that's what he's been doing for the last 7 years, and with their portfolio companies, that's all he focuses on, culture. So he's done a couple interviews that I've gotten a lot out of. He talks about the questions that they ask, either management or they like to actually they like to speak to, I think, about 10 former employees, because in their view, it's like, if you talk to employees that are still working for the company, they might be a little more sort of closed to giving you, the true information, right? And so, whereas if it's former employees, they're more open. But if you want to talk to people who've been there recently, because as you know, cultures can change over time. So that's been really interesting too.
Kip, can you talk just a little bit more about MicroCap Club and how that's helped you in terms of networking or idea generation or anything like that?
Yeah, absolutely. I mean, it's been a huge part of my investment process. Just like network effects can be a huge competitive advantage for a business. I think just for individual investors, it can be a huge advantage as well. So I would say MicroCap Club has expanded my network by at least 50%. It's been absolutely crucial to investment success. And I've made some great friends out of the members of MicroCap Club. I love what you guys are doing with the content. It's like you can see this sort of flywheel just kicking in. It's like the quality of the content is improving, and the quality of membership is improving. And it's really awesome to see. So I'm happy to be a part of it.
Thanks again, Chip, for taking the time to chat. Are there any other ways that people can find you online? I'll put your display name in MicroCap Club down below, but are there any other places online that people can see you, reach you, or see your other content?
I keep a pretty low profile, but I do have a Twitter account. My DMs are open at MicroValue. I don't know if it's worth following me because I don't post at all or tweet it at all. But always happy to have a chat and collaborate.
Great. Thanks again, Chip.
Thanks, Sean. Appreciate it.